we've got a series of charts, data points, conversational pieces. What I'd like to do is maybe start really big picture with this first chart, right? So maybe for the audience, this is, you'll hear this called the quilt chart. What this is doing basically is showing you big picture, right? Big picture asset classes the last decade. So if you're at the top of the page, that was the best performing asset class. And if you're at the bottom of the page, the worst performing, and kind of everything in between. Jason, kind of what this chart tells me, and then obviously I want your perspective. Capital markets bid up assets, and they may bid them up over a series of years, right? So I'll pick on small cap, right? That purple box in 2012 gets bid up, nice returns in 13, 14, a little bit more muted, but still staying up there. But inevitably, you'll see that purple box bounce. The other one that sticks out to me is commodities. Basically underloved for the majority of the last decade. And here you are in 2022, top of the stack. What it tells me is assets get bid up, get bid up, get bid up. At some point they get too expensive and they take a haircut, and we're going to start the cycle all over again. And that cycle might play out over, 5 to 10 years, depending on where the economy's at.
Yeah, I think that this chart certainly does show that volatility. What I would kind of, the year to date, obviously, as David kind of referenced earlier, the market has moved a bit since we got these slides approved by compliance. So kind of the year to date, now you're seeing kind of the S&P down 20, small caps are down 20, internationals down 22, real estate's down to almost 25, bonds are down kind of 12. So, generally speaking, the year to date column is kind of directionally, but just before I kind of comment on that, if you're looking at the chart on the right hand side, as I often joke around, they don't let the chief investment officer be the chief compliance officer for good reason.
And very good reasons.
Just wanted to,
yes,
very good reasons. Yep. So kind of let that be known. But yes, I think what you see here is that this quilt is essentially exhibit number one of why you want to have a diversified asset allocation, unless you think you're capable of kind of picking the very best assets, the asset classes every year. And in years like 2015 and 2018, where municipal bonds are the best performing asset classes, that tends to be something that you don't think you're going to see very often. But whether we're talking about emerging markets or small caps or certainly commodities, you certainly see that there's volatility. And Alyssa and Mike, talked about this in the last session, but cycles have gotten longer. I mean, you talk about commodities being underloved. You're talking about a negative rate of return from the great financial crisis up until 2021. It's certainly, you see these kind of longer cycles kind of present themselves. And I think that can lead to some behavioral issues, like I only need to own the S&P. Okay. But then there's a year like, this year where you're cut, you're down almost, 20%, a little bit over 20%. And I think that mindset can be somewhat problematic, and why we certainly believe in having, a diversified basket of risk assets. And we'll always be apologizing for not holding something, but we're never going to own 100% of the worst thing, and we're never going to own 100% of the best. And we think that is the best way to, on the investment side, right? We're going to talk about this as we go on, but there's the investment side, there's the financial planning side. But on the investment side, owning this diversified basket of risk assets is the best way to get our clients to achieve their goals and objectives.
Yeah, I mean, I think we've been looking for that manager that can find the best asset class every year. We just I don't know if we're just not looking in the right spots. We've yet to find them.
I think they're out there. They just won't. A lot of these guys have converted into family offices, and the Stan Druckenmillers and those folks, David Teppers of the world, right? They're and to quote two famous guys from Pittsburgh. Those guys are not open for business for us. So
right.
Certainly need to own those diversified baskets for sure.
All right, so that was maybe the last decade. Now let's zone in. Like let's lock in on 2022. And to your point. Whenever you run these charts, they become outdated as soon as we put it in the materials, right? I mean, this chart's only 8 days old. It's got the S&P 500 off 16, 17. We're probably off closer to 20, to your point earlier. Mm-hmm. You've got maybe let me slow down here and break down these indices just to set a baseline for the audience. So you've got the Bloomberg U.S. Aggregate. Think of that as the proxy for taxable bonds. Taxable bonds being, generally speaking, safe, secure, limited volatility, limited bounce. You grind out and you clip some coupons, and we're going to get into it, right, in terms of where yields have gone. But historically, if you could grind out, I don't know, what we used to say 2 to 3%, you'd love it, right?
Yeah, I mean, I think when you're looking at the ag, that's U.S. Treasuries and agencies. It's investment, it's all investment grade, and really kind of what you would generally consider to be the safest investments that you can hold. And
yep.
They typically have a negative correlation to risk assets.
And then we add in, yeah, sorry, cut you off. We add in high yield, right? That's just a little bit more juice on a fixed income play. And then we get into, whether it's domestic, you look at the S&P 500 largest stocks based in the U.S. Russell 2000 is more or less a proxy for U.S. small cap. And then we added in 2 additional international, right? So MSCI, ACWI, XUS, that's a mouthful. What is it? All Country World Index, exclude the U.S., so basically global markets. And then we also give you emerging markets. Jason, I think, in having talked to clients here, I think, yes, capital markets, specifically stock markets, have been volatile. But I think the underappreciated side of this is obviously seeing the ag off 12. Something we haven't seen in 40 plus years, right? I mean, previous to that, what was the worst ag year? Off 3, 4, maybe 5?
Yeah, I think that you don't typically see that, and I think a lot of it has to do with the major drivers of why risk assets in general have really struggled, right? And so for the last 40 years, my parents, Bruce and Linda Staley, they got married in 1980. They got a mortgage. I think they were making like a combined $22,000 a year as teachers, and their first mortgage, I believe, had like a 16 handle on the interest rate.
Yep.
And I think that was kind of like peak. That was just the greatest Reagan and Volcker were getting going. And then from that point on, you saw this declining interest rate environment. And in addition to that declining interest rate environment, where I think the 10-year got as high as in the teens before Chairman of the Federal Reserve Volcker and under President Reagan's administration, really kind of flexed their muscles and really kind of tamped down the inflation. What you saw was not only did interest rates go from 16% on the 10-year to call it a half of 1% during COVID. So when you think about that secularly declining relationship, right, that secular decline in interest rates, it also coincided with a major decline in inflation. So you had kind of this 40-year tailwind where inflation was falling, and so were interest rates, and they kind of go hand in hand. And as a bond, just to kind of review for those of kind of the first joiners, the way that a traditional bond works, it's like a seesaw. As prices go up, yields go down, and then when yields go up, prices go down, right? So it's
and
kind
we've
of
had
traditional.
We're going to get into yields in a second, but that's what we've had this year, and that's how you're off 12.
Right. And so traditionally when let's just take whether it's the great financial crisis, whether it's the sovereign debt crisis in 2011, energy cracking in 2015, 2016, when the S&P 500, let's just say, declines 10, 15, 20%, like it is prone to do, that's the reason why you earn the equity risk premium, because it's risky to invest in stocks. You would see stock prices fall, and then correspondingly in something like the Barclays Ag, yields would decline because people would be fleeing into bonds, right? They would be going into the safe haven assets. And that is traditionally why a 60-40 portfolio works, because if your risk assets are in trouble, right, your U.S. stocks, large, mid, small, international, developed, emerging, even high yield bonds, while those are kind of having their time in the barrel, so to speak, your high quality bonds, whether that's the ag or high quality municipal bonds, typically they appreciate in value because investors are seeking that protection. And that has been the one anomaly that we've had to deal with this year as asset allocators, investors, and dealing with, and most importantly, clients, right? Because this is your life's work. This is your life savings. we haven't really had that traditional ballast to the portfolio. Have bonds held up better than stocks? Sure, they have, but that spread when you're looking at the S&P down 20 and the ag down 12, that's not going to create a lot of comfort in a portfolio. And really the reason the stocks are down, and I think that the U.S. Federal Reserve just raised the interest rates by 0.75% or 75 basis points for the third straight time in a row. And you've essentially taken what was a zero interest rate environment and you've taken it to what the Fed is now saying might be a 4% is the new neutral rate. So that's, a 400% increase, right? If you think about, from where their policy targets are. And a lot of it has to do with inflation. And it's the perfect sequence is that when you throw the kind of money that the United States government and other world governments put into the system to combat COVID, right? And not to relive, the March of 2020, but when you put the global economy into a coma and you don't want to create an economic calamity, a lot of money was printed, right? Put into the system to make sure that economic activity stayed at a reasonable level, and that's why you saw, in the kind of the mini recession that happened in 2020, incomes rose in a recession, and that has never happened ever. Typically, people are losing their jobs, and in this case, not only did less people lose their jobs than originally expected, the ones that did lose their jobs got their jobs back more quickly, and you had these government stimulus payments that kind of came through. All of that money, all of those, whether it's services, capital goods, all that demand really spiked, and it created stresses on the supply chain. And David, you'll go over this chart, but inflation, for you and I, right, who have basically our entire lives we've seen declining interest rates and declining inflation. This is a long cycle that the trend seems to be reversing. And you can walk through the CPI slide, but this is something that we have not had to deal with, and I would say, a little over 40 years.
Yeah, let me, just for the benefit of the audience, right? So what we're showing you here, CPI, or Consumer Price Index. So the headline number, right? Let's play off of what Mike gave us earlier. The CNBC tagline: inflation super hot, right? And it's just going to be there in red and just pounding at the bottom. In August, we got a print of 8.2. That followed a print in July of 8.5, which you can see here. The one you can't see, right, is when we touch 9.1 in June. All of these inflation numbers are numbers we haven't seen in 4+ decades, right? Jimmy Carter was running in the White House, if you will. And then, I don't know how you feel about these, right? There's other ways to slice and dice this, but I don't really care what metric you look at. Core CPI, okay? So strip out maybe some of the more volatile stuff. You look at food and energy, and we're going to get into that here, right? Because when you start talking capital markets, you're going to start to talk about the things impacting the food and energy and global supply chains. But, we got our most recent data point yesterday from the Fed, right? And they moved, to your point, the third 75 basis point increase, third in a row, I should say. So now the Fed funds range is 3 to 3.25, and public markets basically are saying, look, that looks like it's going to 4, 4.25 by the end of the year. So maybe give the audience, hey, why is inflation so problematic? And the Fed is trying to be as vocal as possible, saying, look, if we end up going into a recession, so be it. We got to get inflation to heal.
Well, I think part of the and I'll take it back to Chairman Volcker, because I think that when you go back and you read his, what he was writing at the time, and he's one of, the people that I've really relied on in terms of trying to go back and get knowledge about inflation. He broke inflation in the late 70s. Maybe just give people context, right? Yeah. So there were a lot of things that were going on. Quite frankly, that were different than what they are today, and I don't want to give everybody a history lesson. As David said, I can be long-winded, so I'm going to try to be pretty short with this. But from kind of you look at the kind of the ending of the Vietnam War, the oil embargo, things going on with the Iranian hostage situation. There was this energy and food. There was this, we kind of thought we broke it, and there was a big policy mistake. And Dave, you can see that in the chart. In 1974, the Fed basically did a mission accomplished victory lap, and it rose again. And that's kind of what Jerome Powell is looking at the 70s and saying, like, we're not doing that. We're not going to go from 12 to, call it 5 on headline inflation, then have that headline number, which is the light blue, spike all the way back up to 15. We're not going to do that. So we'll keep rates higher for longer. We'd rather have a policy mistake in that we put the country into a recession, and what kind of recession, we're still trying to figure that out. But we'd rather have that than the alternative, which is kind of this double dip or this head fake that you see in the first part of this chart. But really, what becomes problematic about inflation, what Chairman of the Federal Reserve Paul Volcker did, Ronald Reagan appointed him to be Chairman of the Federal Reserve. His worry was once inflation gets into the system, if you do not get it out, it tends to move around and it's really sticky. And that's kind of what we're seeing right now, where there were different drivers of that inflation number. A lot of, the first part of this, it was kind of capital goods, right? You have this stimulus payment. Let's go buy a new iPhone. Let's go buy a new car, right? Now, I think everybody has seen the stories. If you've tried to buy a new car over the last 2 years, it's been incredibly difficult. Home prices have rocketed up. And now, so now as capital goods, inflation is somewhat receding, supply chains are somewhat normalizing there. Now you're seeing inflation in the service sector. So if you go to a restaurant, you might see like in addition to an automatic gratuity charge, a retention and benefit charge. And I was just in an airport in California. It was the first time I had seen it. I was grabbing a burrito at a California pizza kitchen in the San Diego airport. And they had a 2% surcharge that was used for employee retention and retention and kind of attracting them. And that's the first time I'd ever seen it. But you're starting to see that inflation move into the service sector. And the reason that Jerome Powell, again, wants to get this out is because if you look at, if you're a company, you're reporting public earnings, and let's just take, your Pepsi, where you're going to have your commodity costs are going up, your people costs, your human labor costs are going up, your shipping costs are going up. At a certain, in the beginning parts, you can start to, pass those costs on to the consumer, and they will take it. At a certain point, you hit a threshold where you can't continue to push that push those costs onto the consumer. That comes onto your balance sheet. And that's what we're starting to see play out in the public markets when these companies start to report earnings, and where in the first quarter, hey, they were able to pass through almost all of the inflation, all of their cost increases, similar to the second quarter. Third quarter earnings, what we expect to see is more of these charges or these quote unquote earnings misses related to inflationary pressures that the maximum has been, kind of been breached, where they're no longer able to pass through those costs.
All right. So let's say we got another 15, 20 minutes. I'm going to pick up the pace a little bit because I want to get into capital markets, but we gave you the Treasury curve. So again, I'm going to set the stage, add in anything you'd like. What we gave you is basically, where were we at the end of last year? And maybe in layman's terms for the audience, what is the Treasury curve? So let's go to the 2-year. I give my money to the U.S. government for 2 years. At the end of last year, they had said, all right, Dave Brinkman, you get 0.7% of interest for the next 2 years, and then we give you your money back. And then you could jump all the way out to the far right. If I give the U.S. government my money for 30 years, at the end of last year, they pay me 1.9% each year, and they give me my money back 30 years into the future. Jason, the segue here, right? Inflation's running hot. Most asset classes have taken a haircut, a substantial haircut, depending on where you're looking. And this is where we see the yield curve as of last week, right? A substantial move. We talked about the 3 bumps at 75 apiece from the Fed. This, in my simple opinion, I don't care what asset you are basically resetting the cost of capital to fight inflation. And that is what, in my simple view of the world, led to that year-to-date chart where you see every asset down and to the right.
Absolutely. And also what this curve is telling you is that if you look at because it starts to kind of moderate out, and we can talk about yield curve inversions and what they mean or don't mean. But if you look at the moderation of kind of the 5 years and out, you start to see kind of similar lines. What this yield curve is implying is essentially the Fed's got work to do for the next 12 to 24 months, and then we're going to start to moderate out, and that's roughly what the market is saying it's going to take to get inflation back to more normal levels. Now, what normal levels mean? It used to be a 2% target. I think at Schneider Downs and most other places, we think it's going to be meaningfully above that, maybe in the kind of the 3 to 3.5% range is more of a normalized inflation target in the intermediate term.
And I think the other thing this tells me, right, so you heard the commentary yesterday, we've already alluded to it. The other dynamic, we didn't really put any data to this, but the labor market, right? I'm just going to take the government stats and say they're right. You could swing it a couple million one way or the other. But basically, you got 11 to 11.5 million jobs out there, right? I'll say theoretical jobs. Maybe not all of them. Maybe they're putting a job posting out there, and we just hired 3 new advisors here in the last couple months. But we were being selective. We knew what we were looking for. So there's 11 million jobs out there, and more or less you have 5.5, 6 million people unemployed. So if I'm unemployed right now, more or less the data tells me there's 2 jobs out there for every 1 person unemployed, right? And you hear them talking about this. They're like, look, we need to see the labor market somewhat equalize. And again, I think I'm trying to not use jargon to lose the audience, because there's never simple answers to these things, right? I don't want to sound like it's overly simplified, but you're raising interest to cool off the economy, drive down inflation, and if you go into a recession, typically you see layoffs and you find a little bit more equilibrium in the labor market. I mean, that big picture, right? That's the levers that are trying to be pulled domestically here.
Yeah, I think that it's right now where the U.S. Federal Reserve has put itself is it's really trying to thread a needle, and that's really difficult because typically there are a lot of just countervailing forces here. They're typically not in a normal, kind of a normalized market environment or a normalized recession, and they're trying to balance those things. But yes, they're trying to cool off the economy, which is going to kind of decrease the costs on employers. And try to kind of more normalize and have it go through a business cycle, and it's very difficult because if you've gone into an airport recently, it doesn't look like a recession is out there. Planes are full, airports are full, right. People are still spending money, and that's what they're trying to combat.
So I'll make a hypothetical question. I'm in the audience. Hey, Dave, Jason, that's great, but you guys aren't economists. You're financial advisors. So talk to me about investments. Yeah. So this is the S&P 500 going back to the mid-90s through now, right? The booms and the busts, and Mike and Alyssa played off this a little bit. They zoomed this chart out even further to the left, right? But, I think stating the obvious, right? It's been a very volatile year. But, when you start to zoom this chart out, stocks have always been volatile. I'm going to steal your phrase because I think it might be one of your better ones. But generally speaking, stocks go up and to the right over the long run. I think the thing that I've been talking about with clients is, the last 2 years, let's say 20 and 21, generally speaking, we were up and to the right outside of the 30-plus drawdown you saw in March and April of 2020, right? But I remember in the moment saying, hey, Jason, client, like, this is not normal. Things don't just go up and to the right and it's a smooth ride and every month we're adding another 4% on. I think I feel like we got a little bit too comfortable and we kind of forgot assets can be volatile over short periods of time. And I might even say short periods of time or years, not months.
Yeah, I think that there, certainly with the monetary policy, the monetary regime, this kind of low interest rate environment that's been pervasive across the globe since the great financial crisis in 2008 and 2009, investing has certainly seemed a lot easier than we know it historically to be. And, as Mike kind of pointed out, investing kind of comes in long cycles, and that's what's reflected in this chart. You have kind of long cycles of great appreciation, and then you have some very painful drawdowns, and that is essentially how capital markets have worked since the beginning of time. And what I would what I would say, and looking at this chart, is that we certainly think the base case is going to be more volatility, not less. There's some things that we've done in client portfolios to dampen this volatility and maybe take advantage of what we felt like was a likely to be more higher interest rate environment, of what that was going to mean for more traditional risk assets. But
right.
I think it's very important not to lose perspective in that, where we are now is certainly, it's certainly unique, at least in the last 4 years, but people were saying that about the great financial crisis in 2007 and 2009 and the tech wreck in 2000 and 2001. And on top of that, you added 9/11, the world going to war with terrorism. There are a lot of these things that have happened over the last 20 years where in the moment they've seemed like we've never dealt with this before. I think, this is where it's important to kind of take a deep breath and understand that there are some strong drivers longer term of corporate earnings, of where the global economy is going in the short term and even into the medium term, like you said. And I think that we need to start thinking in longer in terms of the short term is kind of 6 to 18 months. And the intermediate term is more like kind of 3 to 5 years. And the longer term is 7 to 10 plus years. I think if we start to put that more into that mindset, I think it will help us help us get through this volatility that we're experiencing right now.
All right, so let's play off of what you just gave me there, the longer term approach. So for the audience, what are we looking at? We're looking at, on the left-hand side, you've got the returns for large, mid, small, based on either value, blend, or growth. You've got since market peaks in February of 20, what have the subsequent returns been? Top right quadrant, year to date, where are we at, right? And then bottom right, where are we at since the lows? The second chart, and this is where I want you to go, comparing current price to earnings, right? So the price of the stock divided by the last 12 months of earnings versus the 20-year average. So my question for you is, all right, I'm a long-term investor. I'm buying what Schneider Downs Wealth Management's selling. I'm disciplined. I'm not overreacting. Give me a little bit more when you look at this, and let's say you did want to lean in, right? You understand markets are volatile. Where do you see, and as Chief Investment Officer, how do you size up current domestic valuations?
Well, I think you have to take into consideration kind of the strength of the U.S. dollar and what that's doing as like this global wrecking ball in terms of.
We're going to get into that here in a second.
Okay.
Yep.
So I think that's first and foremost, but that has an effect. One of the reasons that large cap U.S. large cap stocks are doing so well, right, is they have a lot more kind of exposure to that relative to to some of their small and medium sized peers. I think if we're leaning into anything, we certainly see a lot of value in small and medium sized stocks. I think that first and foremost, that is something that we believe incremental capital for the long term investor. Those look really good. Value as a style, especially as you get into more of the small and medium sized opportunities, looks attractive, both to the 20-year average on the PE and when you look at the percentages. And then I think small cap growth, which has just been absolutely crushed. There's a lot of things working against it, but you look at that, and it's the first time you can say that small cap growth isn't super expensive, and for the longer term investor, could be compelling. We think, though, again, kind of in terms of asset allocation, the volatility in small and medium sized stocks, there's a reason that you can earn a premium there, right? Because there's volatility. But we think there's a lot of value there. We certainly think that opportunities have presented themselves. The last time that small cap and mid cap stocks were valued where they are now, roughly kind of like 10, 11-ish type earnings, you have to go all the way back to kind of 2008, 2009, and that was a really good entry point for the longer term investor. Yep.
Now let's go outside capital markets. And the one thing you and I talked about as I set the stage here, so you are looking at most regions globally speaking from an equity market perspective, year to date, and then 2021, and then we give you some 15-year stats. The thing I want to highlight to people is that local column, right? Because we haven't alluded to it, but the U.S. dollar is breaking all kinds of records, right? I went to Europe with 3 other buddies, had a great time, probably late 2000s. It was the wrong time to be going, right? The euro was strong against the dollar, and what if we touched parity within the last couple months, right? US to euro.
Yes, it's right now it's trading at a 98 kind of 0.98 euros for every $1. So yeah, it's broken.
So I think that's underappreciated, right? So maybe educate the audience on the impact currency's having when you take your US dollars as a US investor and you go offshore and then you bring it back home. Like, because you can see here, like I'll pick on the EFI. In local currencies, it's off 7. You bring it back home, it's off 19, right? And
right.
You and I talked about this. And generally speaking, this is why we're not giving up on international equities, because you look at valuations, and even if the currency just flips modestly, it becomes a tailwind.
Right. And I think the one thing that needs to be said kind of before we talk about the relative valuations is that the relative currencies tend to get back to equilibrium. There's reversions to the mean, but they tend to have like really, really long cycles where, one particular currency will certainly appreciate. And that's kind of where we are with the dollar. And I think that, yes, the international stocks and, full disclosure, we've been, we're believers in them, right? We hold them in a diversified asset allocation, but it's been difficult to hold. And I think we need to, acknowledge the fact that, as investors, sometimes, I know that I certainly have been more excited about valuations there. So really, think that if you do get the, decline in the dollar and you look where valuations are of these, of international stocks, they need a catalyst there, but they're certainly attractive over the medium and long term. Yeah.
You're going to need the geopolitical concerns to die down as well, right? We don't have enough time to dive into that.
Resolution in Ukraine. If you could get some kind of, stand down in Taiwan and China, I think that would be, those would be incredibly helpful, but we really need to start to see the dollar decline. Yeah.
Let's say we got 5 minutes or so left. I wanted to give you the opportunity because for most of our clients, it's not just stocks and bonds. And most of our commentary thus far has been about stocks and bonds. Maybe I'll be your hype man here. Jason, you've done a phenomenal job in building out our private platform. And I wanted to just give you the opportunity to maybe educate some of those clients out there, some of those new contacts that aren't familiar with us. And how do we think of this? Now, I will caveat this with this is generally going to be a larger portfolio, right? You have to be able to bear illiquidity. This doesn't have, we would not be talking to you with a couple $1 million portfolio for things like this. I want to caveat that for the audience if the client's like, hey, how come I didn't know about this? But, generally speaking, give us some thoughts on what we're seeing on maybe the more private or, you might hear called alternative investments and what we think about out there.
Yeah. I think that, a lot of this is if you're just, take private equity for kind of the general terms, whether that's buyouts or growth equity or venture capital, you have certain benefits, right? The S&P gets marked to market, I don't know, a couple 100 million times a day when the SPY trades. Some of the benefits of having private equity are that you have a longer, it's private, it's not getting marked every day. So from an investor psychology standpoint, that is I think it's a feature, not a bug. You're able to kind of execute on your business plan without, people like me and Dave in a previous life, working for William Blair, was an equity research analyst, and you're asking questions of the CEO and they've got these 5 and 10-year plans, capital plans. And you're like, well, what happened in the last quarter? Well, in private equity, you don't really have.
The most recent data point is FedEx, right? FedEx thinks they're still going to hit their 3 to 5 year targets, but look right in front of them, the volume's drying up in Asia and Europe, and the stock took a 20% dump last week.
Exactly, and I think that's that's one of the benefits of having this kind of a piece of your portfolio to the extent that you can bear it in private equity, where you have a longer time horizon. You're able to execute a business plan away from kind of, people like Dave and I questioning whether your business plan are you actually executing on it? And you have this ability. And then I think that there's so many of these businesses in the United States that touch us in our daily lives are not publicly traded. And you'd love to have access. I can't tell you how many times I've gone by, like Mr. Magic Car Wash, right? There's a car wash in Pittsburgh. And I always see it full. I was like, man, I'd love to own that. It's not publicly traded. Can't buy it. And private equity gives you the ability to buy some of those businesses that you really like, that we think are attractive. And I think that it's a part of the overall portfolio. There is equity beta, right? It's an equity just like a publicly traded stock. It just has the benefits of being held privately and having to be able to execute the business plan in a manner that is conducive and to the long-term returns of the investor, we think. On the real estate and real asset side, we have been proponents of this. We have been overweight these asset classes in traditional portfolios, and we've talked a lot about our some of our interval strategies that have infrastructure, farmland, and timberland, and then high quality commercial real estate. But we also have options in a drawdown private investments where you're talking about owning liquid natural gas terminals in Lake Charles, Louisiana. You own hydroelectric dams in Calgary, Alberta. We have this ability to take on kind of this illiquidity and generate what we think are attractive returns that help our clients reach their goals and objectives. And I think for some of our clients, especially who are private business owners, a lot of the private investments, it actually makes more sense to them. When you're owning a real asset or you're owning and operating this business, they have more control.
Theoretically,
Dave,
right?
how many conversations have we had with clients where they'll see a company that doesn't make any money, that was like bleeding hundreds of millions of dollars a year, and it was up 200%, and they're asking us, well, help! I can't run my company like that. This is another way for us to earn equity returns, better than equity returns, we think, over the long term. In a way that helps that investor psychology, right? You're a long-term investor. These are illiquid. You're forced to see them through. Again, that helps. And you get to own businesses that you wouldn't otherwise own in public markets. So it's diversification as well.
And I'll hit on this, and then we're going to go to the bull bear, and that'll be our wrap. But we also look for managers that, like set it up investor friendly, keep the fees at a reasonable level, right? Because you can be the best manager in the world, but I come in at the LP level or limited partner level, and the fees prevent me from earning anywhere close to what I think I should earn to take illiquidity.
Absolutely right. You want to have a significant alignment between the general partner and the limited partner.
Yep. All right. And sorry to rush you here, but let's another minute or two on this. So on the left-hand side, all right, let's get back to the peak of January 2020, more or less. What do we need to earn to get back to where we were? If you're going to try and get there in a year, you're going to have to compound at a pretty good rate. 2 years, you're buying yourself a little bit more realistic. 3 years, now you're starting to get into long-term. The S&P 500's giving you 10, right? It's not been a smooth 10. It bounces around. 4 or 5 years, right? I think that more or less reinforces, guys, you got to take a long-term view. We're not asking you to be happy. We get it. Stocks have taken a hit. But where I want you to go is that bull bear and maybe the length and what that tells you.
Yeah. Well, so if you look at the average bull market lasts 51 months, the largest bear market lasts 20, or the average bear market lasts 20 months. So bull markets last, 2.5 times as long as bear markets. But why are bear markets so hard to get through? Because it's so hard to look at drawdowns in your portfolio. I mean, you can go back and think about, well, I had to miss my son's baseball game, or I had to miss my daughter's soccer game to earn that money. And then to see it decline, it's really hard. I just, stay away from my wife and kids. There are these things that things that you miss along the way, your spouse, right? And I look at the kind of the 4 to 5 year chart, and I think that the 5 year 5.7%, just to get back to where we were in January, I think is something that's a lot more realistic of a lift than the 1 year. But the bull and the bear market, if you're you're a working mom, right? And you're away from your kids, you're trying to save for retirement, save for weddings, and you see this bear market happen. I mean, and you're like, it's just so hard in the moment. And I think if you zoom out and you just look at it and you say, the average bull market return is 162%. It lasts 51 months in duration. The average bear market return is down 40. I'm not saying that's okay, but it's down 40 and the duration is 20 months. I think that these are things that we can use as advisors in working with our clients to try to put that perspective in, so that we're able to to navigate through these difficult times, to get to calmer waters and make sure that the trajectory of your financial plan is still in reach, and your goals and objectives are still good to go.
Well, Jason, thank you for joining me. Obviously for the audience, we're trying to get this in a 30-40 minute window. We would welcome a chance to have additional conversations. Please reach out to us.